90-day trading challenge series part 6, float versus shares outstanding, the volatility secret. Alright, you've learned about candles, trends, volume. Now let's unlock the supply side of the game. This one, total game changer for spotting explosive stock. We're talking about float. What is float? Float is the number of shares available to trade in the open market. It doesn't include insider shares or shares held by the company. Think of a float like a liquid supply of shares. It's what retail and institutions are trading every day. Shares outstanding versus float. Don't confuse the two. Shares outstanding equals total shares in existence. Float is the portion that's actually tradable. A company might have 500 million shares outstanding, but if insiders own most of it, the float could be way smaller. Why float matters? Especially for volatility, this is where it gets spicy. Low float equals fewer shares available, which leads to bigger price swings. High float equals more supply, slower price action. That's why meme stocks like GameStop and AMC went crazy. Low float plus high demand equals rocket fuel. When there's limited supply and massive buying pressure, the price doesn't just go up, it launches. But heads up, volatility, opportunity, and risk. Real world examples. IPOs, that's when a company releases a set float into the market. Buybacks, they reduce float, tightening supply. And secondary offerings, they increase float, creating more selling pressure. Smart traders track float changes because it tells you how sensitive the stock is to demand. Now, quick float rules for beginners. Low float, under 10 million shares, can move 30 to 100% in a day. Medium float, 10 to 100 million, moderate volatility, tradable. And then high float, plus 100 million and higher, slower, steadier movers, think blue chips. Same market cap, different float. One stock drifts, the other rips. Next up, breakouts and chart patterns, where the move begins. Mr. M out.